Hello everyone, welcome to the 109th episode of me learning how to trade in Forex. So in the last episode we went through swing trading, basically going through what swing trading is. So swing trading attempts to identify swings within a medium term trend and enter only when there seems to be a high probability of winning. So going long on swing lows and going short on swing highs. Types of swing trading: reversal, retracement, breakout, breakdown. You might want to be a swing trader if you don't mind holding your trades for several days. You're willing to take fewer trades but more careful to make sure your trades are very good setups. You don't mind large stop losses. You are patient. You are able to remain calm when trades move against you. You might not want to be a swing trader if you like fast-paced, action-packed trading. You are impatient and like to know whether you're right or wrong immediately. You get sweaty and anxious when trades go against you. You can't spend a couple of hours every day analysing the markets. You can't give up your World of Warcraft raiding sessions. And then that's that. So now we're on to position trading. Position trading, this should be in caps. Date is the 18th. Position trading. Position trading is the longest term trading and can have trades that last for several months to several years. So the longest term trading can have trades which last for several months to several years. Position traders ignore short-term price movements in favor of pinpointing and profiting from long-term trends. So traders ignore short-term price movements in favor of pinpointing and profiting from long-term trends. In favor of pinpointing and profiting from long-term trends. It is this type of trading that most closely resembles investing. The crucial difference in markets outside Forex: investing usually means you hold positions that are long. This kind of Forex trading is reserved for super patient traders and requires good understanding of the fundamentals. Position trading requires a good understanding of the fundamentals. Because position trading is held for so long, fundamental themes will be the predominant focus when analysing the markets. Fundamentals dictate the long-term trends of currency pairs, and it is important that you understand how economic data affects your countries and their future outlook. Fundamentals dictate the long-term trends of currency pairs, and it is important that you understand how economic data affects your countries, your country and your country and their future outlook. Because of the lengthy holding time of your trades, your stop losses would be very large. Position trading will have very large stop losses. This means that your losses can end up being huge, but it also means your profits can be huge. Huge in Trumplish. You must make sure you are well capitalized or you'll most likely get margin called. position trading can either gain huge profits or losses. You must be well capitalized, aka have lots of money, or you will most likely get margin called. For an idea of how much money you should have in your trading account, check out our risk management lesson. Position trading also requires thick skin because it is almost guaranteed that your trades will go against you at one point or another. These won't just be little retracements either. You may experience huge swings and you must be ready and have absolute trust in your analysis in order to remain calm during these times. During position trading, it is almost guaranteed that your trades will go against you at one point. You may experience huge swings. You must be ready to have absolute trust in your analysis in order to remain calm during these times. Yep. Types of position trading. While fundamental analysis plays a large role for position traders, that doesn't mean that technical analysis isn't used. Position traders tend to use both fundamental and technical analysis to evaluate potential trends. Here are some trading strategies utilizing technical analysis that position traders use. So, types of position trading. Trend trading using moving averages. The 50-day moving average and the 200-day moving average indicator is a significant technical indicator for positional traders. The reason for this is due to the fact that these moving averages illustrate significant long-term trends. So the 50-day moving average and the 200-day moving average are significant technical indicators for position traders. The reason for this is due to the fact that these moving averages illustrate significant long-term trends. When the 50-day moving average intersects with 200-day moving average, this signals the potential of a new long-term trend. When the 50-day moving average intersects the 200-day moving average, this signals the potential of a new long-term trend. When the 50-day moving average crosses below the 200-day moving average, it is known as a death cross. When the 50-day moving average crosses above the 200-day moving average, it is known as a golden cross. These longer term moving averages are popular chart indicators for position traders. When 50-day moving average crosses above the 200-day moving average, it's called the golden cross. When the 50-day moving average crosses below the 200-day moving average, it's called the death cross. Support and resistance trading. Support and resistance levels can signal where a price is headed, letting position traders know whether to open or close a position. Support and resistance can signal where a price is headed. Support and resistance levels can signal where the price is headed. A support level is a price level that historically does not fall below. These historical support levels can hold for years. So support and resistance levels could hold for years. I'm just going to write that in there because I don't really know if that's true or not. If position traders expect a long-term resistance hold, they can close out their positions before unrealized profits start melting away. They may also enter long positions at historical support levels if they expect a long-term trend to hold and continue upward at this point. So, pretty basic. Close out positions before unrealized profits. So, basically close the position if it comes to a resistance level. I guess this is when you're going long. So pretend the graph is going up and then it hits a resistance level, then you close your position there so that it doesn't the price doesn't drop back down again because of this resistance level. With the support one, continue upwards, enter a long position. Yeah, so they expect the price to go up, so the price bounced off the support and then they enter a position at the support level and then the price bounced back up, so that's why they open a long position. This strategy requires that traders analyze chart patterns. When analyzing the chart, position traders consider three factors when trying to identify the support and resistance levels. The historical price is the most reliable source when identifying support and resistance. During periods of significant up or down in the market, reoccurring support and resistance levels are easy to spot. Position traders consider three factors when trying to identify support and resistance levels. So historic price is the most reliable source when identifying support resistance. During periods of significant up or down in the market, reoccurring support and resistance are easy to spot. Historical price is the most reliable source when identifying support and resistance. During periods of significant up or down in the market, reoccurring support and resistance levels are easy to spot. Recurring support and resistance levels are easy to spot. Previous support resistance levels can indicate future levels. It is not unusual for a resistance level to become a future support level once it has been broken. So previous support and resistance levels can indicate future levels. A resistance level, a broken resistance level could become a support level. Technical indicators like moving averages and Fibonacci retracements provide dynamic support resistance levels that move as the price moves. Technical indicators like moving averages and Fibonacci retracements provide dynamic supports and resistance levels as the price that move as the price moves. Breakout trading. Trading breakouts can be useful for position traders as they can signal the start of a new trend. Breakout traders use this technique to attempt to open a position in the early stages of a trend. A breakout is where the price moves outside defined support resistance levels, preferably confirmed with increased volume. The idea behind trading breakouts is to open a long position after the price breaks above resistance or open a short position when the price breaks below support. To successfully trade breakouts, you will need to be confident in identifying periods of support and resistance. Opening a long position after the price breaks above the resistance level, or opening a short position after the price breaks below the support level. You will need to be confident in identifying periods of support and resistance. To successfully trade breakouts, you need to be confident in identifying support and resistance levels. And you also need to identify where a potential breakout could be happening, right? Yeah. Pullback trading. A pullback is a short dip or slight reversal in the prevailing trend. The strategy is used when there is a brief market dip in a longer term trend. Pullback traders aim to capitalize on these pauses in the markets. The idea behind the pullback strategy is this: for long traders, to buy low and sell high before market briefly dips, and then to buy again at the new low. So for long traders, if you want to go long, go to buy low and sell high before the market briefly dips, and then to buy again at the new low. So buy again after the market dips again, or the market dips. For short traders, sell high and buy low before a market briefly rallies, and then after price does rally, sell again at a new high. Right, yeah. If executed successfully, a trader can not only profit from a long-term trend, but avoid possible market losses by selling high and buying the dips for long trades, buying low and selling the rips for short trade. What's a dip or a rip? Buying the dips. I'm guessing the dips is like the bottom of the U. So pretend there's a U shape here. The dip is like at the bottom bit, so where it's the low. Buy low, sell high. Sell high, buy low, right? Is that what they mean? To help identify potential pullbacks, you can use retracement indicators like the Fibonacci retracement. Used when there is a brief market dip in a longer term trend. When going long, buy low and sell high before the market briefly dips, and then buy low and then buy again at the new low. So when going short, sell high and buy low before the market rallies, and then sell again at the new high. To help identify potential pullbacks, you could use retracement indicators like the Fibonacci retracement. You might be a position trader if you are an independent thinker. You have to be able to ignore popular opinion and make your own educated guesses as to where the market's going. You are an independent thinker. You have to be able to ignore popular opinions and make your own educated guess as to where the market is going. You have a great understanding of fundamentals and have good foresight into how they affect your currency pair in the long run. Great understanding of the fundamentals and have good insight into how they affect your currency pair in the long run. You have thick skin and can weather any retracements you face. You can weather any retracements you face. You have enough capital to withstand several hundred pips if the market goes against you. You have enough capital to withstand several hundred pips if the market goes against you. You don't mind waiting for your grand reward. Long-term forex trading can get you several hundred to several thousands of pips. If you get excited about being up 50 pips and already want to exit your trade, consider moving to shorter term trading style. You can wait a long time before, well, not you can, you don't mind. You don't mind waiting a long time before realizing your profit. You are extremely calm and patient. You are extremely patient and calm. You are extremely patient and calm. You might not be a position trader if You easily get swayed by popular opinions in the markets. So basically, I think all these points are the opposite of the points above. You easily get swayed by popular opinions about the market. You don't have a good understanding of how fundamentals affect the markets in the long run. You don't have a good understanding of how fundamentals affect the market in the long run. You aren't patient. Even if you're somewhat patient, this still might not be the trading style for you. You have to be the ultimate Zen master when it comes to being this kind of patient. You aren't patient enough. You don't have enough starting capital. You don't like it when the market goes against you. The market goes against. You like seeing your results fast. You may not mind waiting a few days, but several months or even years is just too long for you to wait. You like seeing your results fast. Okay, what type of trader are you? In the previous lessons, we went through a variety of trading styles. Hopefully you can identify which one may match you the best. If you've already forgotten what trading style is, unfortunately for you, it's time for a review. There are 4 main types of trading styles. Types of trading styles. So scalper, day trader, swing trader, position trader. Scalper, day, position, swing. Scalping. Scalping is a fast-paced trading style where traders aim to profit from small price movements by executing numerous short-term trades throughout the day. So scalping. Fast-paced trading where traders aim to profit from small price movements by executing numerous short-term trades throughout the day. Typically holds positions for a few seconds to a few minutes and rely on technical analysis to identify entry and exit points. Rely on technical analysis to identify entry and exit points. Their main objective is to grab very small amount of pips as many times as they can throughout the busiest times of the day. Main objectives to grab as many pips as they can throughout the busiest times of the day. So main objective is to grab very small amount of pips as many times as they can throughout the busiest times of the day. Day trading. Day trading is a style where traders open and close positions within the same trading day. A style where traders open and close positions within the same trading day. Day traders may use a mix of technical and fundamental analysis to capitalize on intraday price fluctuations. So uses a mix of technical and fundamental analysis. Day traders usually pick a side at the beginning of the day, so usually pick a side at the beginning of the day and finish the day with either a profit or loss. These kinds of traders do not hold their trades overnight. Does not hold their trades overnight. Swing trading. Swing trading is a style that involves holding positions for several days to a few weeks. Holding positions for several days to few weeks. Seeking to profit from short to medium term price trends. Seeking to profit from short term, medium term price trends. Swing traders may use a combination of technical and fundamental analysis to identify potential entry and exit points. So uses a combination of technical and fundamental analysis, basically the same as day trading, pretty much. Uses both. These types of traders can't monitor their charts throughout the day, so to dedicate a couple of hours to analyzing the market every night to make sound trading decisions. So wait, may not be able to monitor the charts throughout the day. Okay, position trading. It's a long-term approach where traders hold positions for weeks, months, or even years. Long-term approach where positions are held for weeks, months, and years, aiming to capitalize on significant price trends. Aiming to capitalize on significant price trends. Position traders primarily rely on fundamental analysis. Primarily rely on fundamental analysis. To identify undervalued or overvalued assets, with technical analysis serving as a secondary tool. So still use both, but also use technical indicators. There we go. These traders know that fundamental themes will be the predominant factor when analyzing the markets and therefore make their trading decisions based on them. Undervalued or overvalued assets. To identify undervalued or overvalued assets. put a table into all of this. So note to future self, could do a table with like summarizing all these instead of writing a massive fat paragraph here. So yeah, a table. So for example, the 4 trading styles on the left side, and then length of time, suitable length of time or something like that. Like profit size, ideal profit size, or target profit size. And then, is the trade held overnight? Yes, no. Does the trader require to be looking at charts most of the time when doing the trade? Yes or no. What else is there? Analysis type used, so either, for example, technical analysis here, but then the rest of it is going to be fundamental and technical, and yeah, that sort of thing. So there we go, note to future self. These traders know that fundamental analysis themes will be the predominant factor when analysing markets, and therefore make their trading decisions based on them. Yeah. Summary. Identifying your trading style is a crucial step toward developing a personalized trading strategy that complements your strengths and weaknesses. No matter what style you choose, you have to make sure that it truly fits your personality. By understanding and embracing your preferred approach, you can create a sustainable and consistent plan that increases your chance of success in the markets. Always changing your trading style can lead to trouble and is a surefire way to blow your account. So I guess that means once you choose a trading style, then you kinda have to stick to it, but you can adjust it as you go along, right? Because you can't always, if it doesn't work, then you kind of have to adjust it to make it work for yourself. That said, if you try scalping, you realize after a week that's too fast or too draining, then be flexible enough to switch up. Yeah, there we go. There is no one-size-fits-all solution in trading, and the key to long-term success lies in self-awareness, continuous learning, and adaptation. If a trading style... No. Ensure you adjust... I don't want to say just the trading style, but it's like ensure you adjust the trading approach to suit your personality. There we go. Ensure you adjust the trading approach to suit your personality. Okay, how to create a mechanical trading system. To create a mechanical, caps lock, trading system. So far, we taught you how to develop your trading plan. We've also discussed how important it is for you to discover which type of Forex trader you are. Now it's time to teach you how to add some meat to your thin trading plan by showing you how to create a Forex trading system. More specifically, we're going to teach you all about Forex mechanical trading systems. Mechanical trading systems are systems that generate trade signals for a trader to take. So mechanical trading systems generate trade signals for traders to take. They are called mechanical because a trader will take the trade regardless of what is happening in the markets. In theory, this should eliminate all biases and emotion you're trading, because you are supposed to follow the rules of the system no matter what. The trader will take the trade regardless of what is happening in the markets. If you do a simple search in Google for Forex trading systems, you'll find many people out there who claim to have the holy grail system that you can purchase for only a few $1,000s. These systems supposedly make thousands of pips a week and never lose. They will show you the supposed results of their perfect systems and will make your eyeballs turn into dollar signs as you sit there and say to yourself, wow, I can make all this money if I just give this guy $3,000. Besides, if his system were making thousands of pips a week, I'll be able to make my money back in no time. Slow down, cowboy. There are some things you need to know before you give them your credit card number and make that impulse buy. The truth is that many of these systems do in fact work. The problem is that Forex traders lack the discipline to follow the rules and then go along with the system. The second truth, if there's such a thing as a second truth, is that instead of paying thousands of dollars on a system, you can actually spend your time developing your own mechanical trading system for free, and use that money you are going to spend as capital for your Forex trading account. The third truth is that creating a mechanical trading system isn't that difficult. What is difficult is following the rules that you set when you do develop your system. There are many articles that sell systems, but we haven't seen any that teach you how to create your own system. This lesson will guide you through the steps you need to take to develop a Forex mechanical trading system that is right for you. Goals of a mechanical system. We know you're saying, duh, the goal of my mechanical trading system is to make $1 billion. While that is a wonderful goal, it is not exactly the kind of goal that will make you a successful Forex trader. When developing your mechanical trading system, you want to achieve two very important goals. Two goals must be achieved when creating your mechanical trading system. Your system should be able to identify trends as early as possible. Should be able to identify trend as early as possible. Your system should be able to avoid you from getting whipsawed. Should be able to avoid you from getting whipsawed. I think whipsawed is like false breakouts, isn't it? If you can accomplish these two goals with your trading system, you have a much better chance of being successful. The hard part about these goals is that they contradict each other. If you have a system whose primary goal is to catch trends early, then you'll probably get faked out many times. On the other hand, if you have a mechanical trading system that focuses on avoiding whipsaws, then you will be late on many trades and will also probably miss out on a lot of trades. Your task when developing a mechanical trading system is to find a compromise between the two goals. Find a way to identify trends early, but also find ways that will help you distinguish the fake signals from the real ones. If you have no idea where to start, drop by our free Forex trading systems thread on our forums. Tons of Forex traders post their ideas for trading systems, so you may find one or two that you can use when you build your own mechanical trading system. So, system getting identified trends as early as possible. Your system should be able to avoid you from getting fake out. Right. I'm going to leave this episode here. In the next video, we're going to carry on with creating your own trading system, with design your trading systems in 6 steps. So, thank you all for watching, and I will see you guys in the next episode. Goodbye!